Welcome back. You're watching Stock Watch with me, Zinati Guma, and joining me to take your stock-related questions tonight are Gary Booysen from Rand Swiss and Wayne McCurrie from FNB Wealth and Investments. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag StockWatch. Thank you so much for your time, gents. Lots of questions are coming through. So let's get to them. And actually, one that has to do with a counter that had results out today, where we saw the share price surging about 10-11%, OUTsurance. So this is quite an interesting question. Please explain why OUTsurance and Momentum are on such different valuations when PEs are compared. Wayne, let's start off with you.
Look, it's very difficult to evaluate an insurance company purely on a PE, especially a long-term insurer like Momentum or Sanlam or Old Mutual. The best way to value them is actually to look at the discount to, call it net asset value. They've got a special word for it, present value or future benefits. So they've got the thing called intrinsic value, and that's the best way to look at the discount to that, not at a PE. Insurance company, in other words, short-term insurance like OUTsurance, you can evaluate on a PE basis. So it's not really a comparable metric to compare Momentum on a PE basis with OUTsurance on a PE basis. I hope that answers.
Yes, yeah, that's actually quite interesting. Just Gary, on OUTsurance, because there was a lot of enthusiasm today after those numbers. Was the reaction valid looking at those numbers that OUTsurance came out with today?
Oh, well, certainly, I think shareholders were definitely encouraged to see the dividend being raised by almost 30%, and obviously declaring a special dividend as well. So, yeah, I mean, Wayne's 100% right. I mean, typically you need to look at the embedded value on an insurer. It's easy, as he is explaining. You've got a present value, all the future cash flows, and that's very difficult when it comes to an insurance group as well. So, you can look at kind of the other metrics as well. So things like, I mean, how are they rewarding shareholders? So to see obviously the special dividend and the increase in the dividend, I think investors definitely taking heart from that. Looking at their headline earnings per share, also up around 19%. So yes, a good update, and obviously better than the market was expecting.
Wayne, should OUTsurance and Santam be comparable at this point?
To a certain degree, yes. They should in fact be comparable. I mean, obviously OUTsurance have got a different business model, but they're both short-term risk insurers. So yes, they can be comparable. But of course, I mean, OUTsurance will have a far higher price-earnings ratio, will have a higher valuation, because you can just see how they're actually growing their profits at a substantially quicker pace than what Santam is. But yes, you can compare the two.
All right. Well, gents, let's get to more questions. There's one on Capitec. Capitec is now trading at a PE of 31. Does the market believe that Capitec can continue to grow HEPS at historical rates? Gary?
Clearly, the market does believe that. That's why it's assigning this kind of valuation. I think if you look at Capitec compared to the other banking stocks, Capitec, its ROEs have always been significantly higher than the more traditional banking counters, the Standard Banks, Nedbanks, Absas, and FirstRands, and that's one of the reasons, I suppose, that it commands such a high multiple is the growth forecast. So there's not a lot of coverage of Capitec just from a consensus point of view in South Africa, but for the couple of analysts, I mean, we've got probably, we'll call it 10 analysts, when you say sell-side analysts covering it, which kind of create the expectation around where the growth is going to come from. They're actually forecasting a fairly flat year, if I'm just looking at consensus numbers over the next year in terms of top-line growth. But if you look at 2-3 years out, they're expecting kind of mid-teens in terms of revenue growth, which is absolutely spectacular. If you drop to the bottom line, they're looking for around 20% earnings growth per year over the next 3 years. That kind of tapering off a little bit towards the third year. But I mean, that is just absolutely incredible for a business the size of Capitec. Obviously it's taken a lot of market share, and I think it's come to the market with fairly innovative products, and they continue to add users. So you can understand why there's all the excitement excitement around the share price. But banking is also a complex business, and while they don't have some of the legacy issues that the big banks have, it is also, I think, quite a risky prospect when you're buying at these kinds of levels. And looking at the share price up 48% year to date, I would be nervous about getting involved in Capitec at these levels. Just a gut feel.
And that's the thing, because the question, it's always a narrative of, it's quite expensive, and can that share price actually justify future earnings? Yes, maybe historical earnings, but future earnings. Wayne, how do you navigate, that sentiment between historical earnings and expected future earnings for Capitec?
Well, look, it's always a difficult one in Capitec. It always looks expensive. But I mean, simplistically, the other banks are, if the other banks do a good job, they'll grow their earnings at 10%. I know there's exceptions and some special one-offs, et cetera, but let's just say the other big banks will do well to grow their earnings at 10%. Now, Capitec, let's say they can grow at 20-25% sustainable. They deserve to have a price-earnings ratio twice the other banks. They've got a PE ratio 3 to 4 times what the other banks have got. So it just looks, on a short-term basis, expensive. But, as we saw in the middle of last year, if you'd have bought it at 1,500, it's now 3,000 Rand. It's doubled in a year. So any weakness on this one you buy. But just philosophically, proper investment theory now, you cannot grow your earnings sustainably at 30%, just compound into perpetuity. I don't know any company that can do that. So over time, as Capitec's earnings start to, let's say the growth rate starts to fall off, the PE has to fall off as well. But I mean, all of this is investment theory. But in the shorter term, obviously the next year they've given a trading update. They say they're going to grow between 30 and 35%. And a 30 and 35%, a 30 price earnings ratio isn't outrageous.
All right. I hear you there, Wayne. Well, let's go into the Pick n Pay, the grocery retailer. The question is, please ask the panel if current brave and patient Pick n Pay shareholders will be receiving Boxer shares when it is listed. They will. I just forgot what the ratio is. Gary, if you have any of that insight there, but also the viewer says brave and patient Pick n Pay shareholders. I get brave, but is this one where you should be patient, that you should be patient with?
You're saying Pick n Pay without
Yes.
Boxer. So I don't have the ratio. I mean, I can pull it up for you. I'll give it to you later in the show. I'll tweet it afterwards. But in terms of should you be brave or patient, I think the market has definitely lost patience with Pick n Pay over the time, and we've been almost promised a turnaround on Pick n Pay. I think since I've been in the market, I mean, probably from early 2000s, that we're going to see things change. And I think a lot of work has been done now, with Pick n Pay to turn around. I mean, there's been a management team change, but unfortunately, with a business like Pick n Pay, if you look at even just the way they operate compared to Shoprite, just even at a DC level, how they distribute their goods, it's just not as efficient as something like Shoprite. Now, Wayne was talking about investment theory earlier. It does come down to valuation as well. So as an investor, you've got to look at this and say, yes, this probably isn't the same business. It definitely isn't the same business as ShopRite, but it is also significantly cheaper. So if you look at it, is where we have shares trading at the moment, I mean, sitting at just under 25 Rand a share, is this enough of a discount to start to get involved? My feeling is that with the Boxer listing, I mean, that really is the crown jewel of Pick n Pay, that is almost being hived off. So I think it's difficult. I mean, at the moment, I would prefer to have a great company at a fair price than a fair company at a great price. So for my money, I'm still looking at ShopRite over Pick n Pay, and I do hope they get their turnaround, through and done correctly. I mean, obviously, the listing of Boxer is going to help, the balance sheet significantly, but you just get the sense of these are stories we've heard before. It does sound different this time, but those are famous last words in markets. This time is different.
Famous last words for a lot of people. Wayne, brave, sure, but patient, would you be patient? I actually saw today it's up more than 4%. Yeah,
but I mean, it's been very volatile. it can be up 4 and then down 4 and up 4 and down 4. It's been trading between, I'm just having a look at the graph here, between 24 and 25, or 22 and 25 rand now for a while. Yeah, it's a very difficult one. It's the true deep value managers love something like this, because if it comes right, you know, the next stop of the share price is $100, but that's if it comes right.
Yeah.
And it may take a very, very long time to come right. Just on the Boxer, you understand they're not unbundling in the traditional way of giving all of their shareholders all of the Boxer shares. They're selling some Boxer shares in the market to get money to fix up the balance sheet, and then they're unbundling other parts so that you as a shareholder do get some. But if you, let's just say, I mean, just using any figures you want to, let's just say for every 1 rand you got in Pick and Pay, it's now supported by 80 cents worth of Boxer. You're only going to get the 40 cents worth of the Boxer shares. The other 40 is going to be sold into the market. I mean, those aren't the exact numbers, but I'm just showing the sample. Pick and Pay's got another fantastic business, and that's Pick and Pay Clothing. I mean, that's truly a fantastic business. But yes, I would be cautious on this one. You can be so wrong, but maybe if it does come right, let the deep value managers take the 25 rand to 70 rand, and then you can buy it then when you know it's on the solid path to recovery, because these things are riskier. And I agree with Gary. I was a young man when I first heard about the Pick and Pay turnaround.
All right. Well, let's go into Tsogo Sun. Why is Tsogo Sun lagging behind compared to Sun International and City Lodge? Is it because of higher debt or low liquidity? Gary?
I haven't actually traded any Tsogo Sun in a long time, so I can't really speak to the liquidity like I used to. But looking at it, Tsogo Sun is a little bit cheaper than Sun International, just kind of in earnings terms at the moment. You know, from a market cap point of view, they're actually quite equivalent. Although Sun International does have a much higher return on common equity as well, so maybe that's why you're not seeing kind of like the, you know, I don't know. Yeah, looking at it. You know, maybe the stronger currency taking a bit of shine off Tsogo as well. We're in a high interest rate environment, so you know, you look at that, and these kind of companies, they do rely obviously on their gaming, and that is a consumer discretionary spend. So yeah, I can't really speak to why Tsogo would be underperforming Sun International on a relative basis. Yeah, like I said, a little bit cheaper, so maybe there's a little bit of catch up to be played. Sometimes you know, these short term movements are very, very difficult to understand in markets, but longer term you can understand why both of their share prices are maybe a little bit suppressed, and that's because the consumer is under a lot of pressure. We're in a very difficult environment at the moment, and for I suppose tourism orientated stocks, a stronger currency is also not particularly good.
Also another one that the share went up by over 4%. I don't know if it was maybe lifted by the tide. Wayne, Tsogo Sun there compared to Sun International and City Lodge?
Look, I'm quite positive on this sector. I mean, when we look at where we've come from in South Africa, and you look at the conditions going forward with electricity, lower interest rates, hopefully better government delivery, there's just a better spirit around, and hopefully there'll be more money around, and South Africans will actually go out and spend a little bit. So I think the whole sector looks relatively cheap, to be honest, and Tsogo is at a big discount to Sun International, and even City Lodge is at a big discount to City Lodge as well. The stronger rand, as Gary said, the stronger rand doesn't help the overseas people. But even with the stronger rand, it's still cheap, and it's still nice to come out to South Africa if you're from sitting in the UK or in Europe or wherever in the East. You know, even though the rand has strengthened, it's still cheap. So I don't think the overseas tourisms will be that negatively affected by it. So I'm quite positive on the whole sector. I mean, we've got some truly world-class assets here to show people, you know, tourist destinations. And when you look at everyone talks crime, but when you look at the crime statistics for tourism, it's to be honest, it's really, really low. So you're only really in danger in South Africa in crime if you're a South African.
Let's go on to clothing retail. Wade, I'm going to start with you. Your view on Truworths looks like it had a very good ride today. Can we buy more for next year's growth?
I think the answer is yes. I mean, the company doesn't look particularly expensive, even though, as you correctly said, it has actually gone up quite not not too badly at all, but it's still at quite a low valuation on the market. I mean, I'm just having a look here. In the last year, it's up, quite nicely, up 30%. Now, as all the things I spoke about earlier on, it's improving the sentiment here and all of these factors, lower interest rates, etc. We're missing one big one in this particular discussion, and that's the two-pot retirement system.
Oh, yeah.
A lot of extra discretionary income is going to hit this sector over the next 2, 3, 4, 5, 6 months. A lot. So yes, the answer is yes, I would buy it.
Yeah, South Africans being advised to rather reduce their debt, but I don't think so. I think
we're all human.
Exactly. Gary, true words. And do you think that this would be a time to buy more?
I think it's definitely interesting. I think Wayne makes a great point. I actually got my two-pot mailer from one of the product providers today saying, "Oh, it's now in my savings pot and is accessible." And I thought, like Wayne is saying, how many people are now taking this out and squandering the money instead of saving it? But I like Truworth. So I think we're all in good company by saying that Truworth is a buy. So I see one of the reasons that the stock was up today, that HSBC raised its target price from 93 Rand to 105 Rand. Stock was up 4%, but trade closing 99 Rand 48. So there's still a good 5% to hit HSBC's target. It may be a little bit more upside, but it has run hard. But you also understand that a lot of the retail stocks, the property REITs as well, have been running into the idea that we are going to have interest rate cuts in the very near future. And of course, I think the wide expectation is for the Reserve Bank to cut interest rates by 25 basis points on Thursday. And that is going to feed into the retail sector, but obviously markets are forward-looking. So typically you start to see the moves before these things actually happen. So one of the reasons that I'm sure Truworth is up as much as it is, you see a very similar pattern on something like Mr. Price. So a lot of these kind of value fashion and fashion retailers are looking pretty good. The question is, have they run too hard? I don't think so. I think we're at the I think, as Wayne was saying about deep value managers, I think the very easy money has been made, but there's definitely a lot of momentum to these stocks at the moment. And interest rate cycles are long, and I think things are looking better in South Africa. So as we start seeing, although I'm looking at the Fed expectations at the moment, and currently I just cannot believe that they're pricing a 61% chance that we're going to get a 50 basis point cut on Wednesday night.
Wow.
So the probability is that they're doing 0.5%, although I just cannot see that happening. But in a lower interest rate environment where money is a little bit cheaper, economies get a little bit stronger, and I think consumers that have really been through the worst of it and survived. I think these retail stocks could do very, very well. And we have been kind of positioning into them, over the last year or two. I think I've had a couple of them as picks on the show as well. And yes, there's a time where they're going to become ridiculously expensive, and then it'll probably be the time to sell. But I also think that there is going to be a lot of foreign interest as well. Typically, our retail sector does attract a lot of foreign interest. And if we do get, let's say, a 50 basis point cut in the US and only a 25 basis point cut in South Africa, you've also probably got a currency tailwind behind that if you're a foreign investor. So you might also see portfolio flows coming back into South Africa, which would further buoy the sector. So yes, definitely, I like it. I think retail is a nice space to be overweight at the moment.
All right. What about British American Tobacco? Your view on BAT's recent rally, although not so much today. Is it time to sell, or is there still room for it to run? Wayne?
Look, I've changed my mind over the years on British American Tobacco. I mean, we all knew that it was the essentially ex-growth. People just smoke less. But it generates massive cash. You get a proper dividend out of it. But the last, 2-3 years results, the deterioration in the combustible market has been significantly quicker than what I anticipated. And the new products, the vaping, etc., I mean, it's growing strongly, but it's not filling the gap. So what they've been able to do is push margin on their premium brands, etc. I would be cautious buying now. I mean, it's had a serious price run here. I mean, it's up very, very strongly year to date. The little bit of weakness today is really the rand strength, I suppose, coming off, and the share price having gone up quite significantly So if you were overweight this one and fortuitously and you got a bit of a payoff, I would be taking some profits here. I mean, even though the price earnings ratio and the dividend yield still look seriously low, but they're going to struggle to actually grow profits and grow revenue going forward. I mean, it's, as I said earlier on, this has turned from a mildly ex-growth industry to quite a strong ex-growth industry.
Yeah. Gary, would you be smoking on this one or putting it out?
That's a good question. So I think, we've been quite optimistic on British American Tobacco, again, into a falling rate environment, because it also operates, when you see kind of the global hunt for yield, quite cranking up again, that dividend yield on a very stable ex-growth business does become attractive to a whole swath of different investors. And as Wayne points out, an 8% dividend yield is nothing to sneeze at when you've already had a 25% share price rally so far. So also it is looking a little bit more expensive. I think I'd be less excited to get into it now, although you do also potentially have the tailwind of a weaker currency. If we assume that what is it, 1750 is a good level to get out, it is going to offer you a good rand hedge exposure. So I mean, that's one of the reasons that you would include it in a portfolio. But to Wayne's point, exactly, I'm looking at, I mean, this is being a multinational stock. It's a company that we have a lot of estimates on, so we can kind of clearly see where consensus is, and the price discovery on a liquid stock like this is fairly good. But if you look at 1, 2, 3 years, revenue growth, so top line growth forecasts, I mean, a year out you're expecting just about a 4% revenue decline. 2 years out, 2% up. 3 years out, another 2% revenue growth. So they're not growing their top line at all, despite the push into the next generation products. Although I did do an internal survey the other day around, just with the youngsters in the office, and said, how many of you guys actually smoke? Surely you know it's bad for you. And they said, and it's all about the velo pouches these days. You need to stick these little chewing tobacco things in your mouth. I was like, you guys are crazy. But yeah, in terms of earnings as well, so even on the bottom line, yes, we are expecting a recovery in earnings next year. But you're looking 2, 3 years out. I mean, you're expecting earnings to grow. You're talking in kind of mid to low single digits. That's not a particularly exciting stock if you are looking for a little bit more. So with the share price rally, I tend to agree with Wayne. It's been definitely a buy for us in the past. I'd probably say we're moving towards a hold at the moment, and we would accumulate a gain, but only on share price weakness.
All right. Gents, let's move on to your stock picks. Wayne, what are you picking today?
Look, I'm going with Amplatz. I know I've been wrong on this one, and I do apologize for that. But it's been sitting here. I mean, it went down enormously on the back of Anglo American doing a private placing at 515. It's recovered quite a bit since then. And it's the same old story: lower interest rates, better global growth, hopefully some increase in commodity prices, and then specifically for platinum, this battery electric vehicles seem to be falling very flat at the moment. So, I mean, that big threat, and obviously electric vehicle is coming, but it might not be battery electric that will win the race. So in the short to medium term, battery doesn't seem as much of a threat to the PGMs as what was made out to be a year or two ago. And when you talk to the PGM management, they actually say they see no fall off in demand from the autocat manufacturers, no fall off. So hopefully we get some joy in this share. Remember, this share is down from 2,400 to 500, now back up close to 600. So that's what I'll go for. It is risky, but if you get this cycle right, there can be enormous payoffs for you.
All right. Gary, on your side?
I've also got a bit of a controversial pick today, so I think I might get a bit of a lashback on this one. But I'm going to go with Boeing. Obviously, they've had the 737 MAX issues. They left astronauts on the International Space Station with their Starliner, and now they have a machinist strike that looks like it'll go on for a couple of months as well. So you couldn't really ask for more bad news around a company than Boeing currently has. That said, we've got a fair value on the stock, around $220 per share. The stock's currently trading kind of mid 150s. So it seems very cheap. It seems like a lot of the bad news is already in the price. This is a duopoly between Boeing and Airbus. They have a massive moat. It is very difficult to see how essentially aircraft production and commercial airframe manufacturing really can adopt a third participant. It's probably not going to happen. If I look out over the next couple of years, yes, we are expecting this year earnings are going to be under immense pressure. But 1 year out, you are expecting a big recovery in earnings from Boeing as well. And obviously a new management team in place as well. We will obviously monitor it closely because they're going just to see how they deal with the strike. I think it's going to be a great test for the new management team. But hopefully most of the bad news is now in the press. Most of it is in the price, and Boeing can start to surprise on the upside. And it is specifically focused on emerging markets, just with their narrow body frame aircraft as well. They should do well in a falling interest rate environment. Their balance sheet is a little bit stretched after COVID, but again, something that will benefit from lower interest rates. So I think the right type of environment to buy in, and I don't want to say picking the bottom because that's also a very dangerous phrase in markets. But I do think that there's real value in Boeing that could be unlocked over the next 5 years.
All right. Well, thank you so much for your time and for your insights, gents. Much appreciated. That is all for tonight's Stock Watch. Thanks to our guests, Gary Booysen from Rand Swiss and Wayne McCurrie from FNB Wealth and Investments. Up next, The Close. Stay tuned.